Good afternoon, ladies and gentlemen. A warm welcome to you on Business Today Television on a day where there is literally carnage as far as IT stocks are concerned. Of course, they've been beaten black and blue, but there is some sort of sanity returning either because of short covering or because of value buying. Only time will tell. But it's been a painful day for the Nifty, and a large part of this 300-point loss that you see on the index is primarily because of the pain that is there in IT stocks. Look at Infosys, it was down 6-7% in early trade. There is some sort of short covering that has come in as well. Earnings by Hindalco and Muthoot Finance also soured sentiment on the Lal Street, but pain across the board. What you see on TCS is a 6-year low on the stock, mainly because of progress made by artificial intelligence. And that, ladies and gentlemen, is a pain that Dalal Street is bearing at a very heavy cost. What needs to be done at this point of time is to discuss quality stock picking and to discuss the long-term health of your passive portfolio. It gives me immense pleasure to welcome a very young stock picker. He is young only in age, but has a very deep understanding of how balance sheets, how profit and loss accounts, how ratios work. And pleasure to welcome Mr. Ashish Kila. He's the director for the Perfect Group. This is a New Delhi-based NBFC which finances two-wheelers, and Ashish is also the CIO of Perfect Wealth. He manages his own money and for the NBFC as well. Ashish, a very warm welcome, and as I was saying, a very young head on very strong and mature shoulders. We will be discussing quality stocks for the long term, and as Ashish is always right to say, that this is an educational discussion. The stocks that we are going to discuss, if you feel they should be a part of your long-term portfolio, please also consult an independent advisor, both on the fundamental and the technical side. Ashish, a warm welcome. First, your comment on IT index. What do you think is happening, and for how long will this pain last?
Good afternoon, Sharendraji. I think, see, whenever an industry faces disruption, in this case, for example, the IT industry in India especially has always been an implementer or an executor of overseas enterprise software and everything. Now, when AI can do that work quickly, more efficiently, the industry is facing a kind of a moment where you need to rise like a phoenix. If you go in the past, when camera technology was there, Kodak used to be the leaders. When digital films came, Fuji came as a leader. Similarly, what happened in other industries also, when, for example, video rental services, Blockbuster was there, then Netflix came. So typically, when you see industry getting disrupted, new players tend to emerge. A lot of incumbents are not able to match up to the disruption age. And at this point, as a time of an investor, one should look at companies which are preparing themselves or which are doing good work in AI and using AI to manage the new challenges which are rising in IT. And sometimes incumbents are not able to respond to these things in the same flavor and manner. And that's why they're suffering, and that's why the pain, because terminal value comes into question, because the valuations take a beating.
Yes.
So our advice is not in terms to catch falling knives, but to assess which business models are not broken and which are resilient as per the future. That is how I would look at the IT opportunity.
Okay. Now, your answer gives rise to two questions. One, IT is widely held in India. It's one of those phenomenal success stories that we've seen over the last 35 years. Of course, you're not 35 years old, but I have spent that much of time in the market. Immense wealth has been created, and sure enough, a large part of this wealth is now getting eroded. For those who hold frontline IT companies, even frontline mid-cap IT companies, what do you suggest they do? Wait for this pain to come out, because balance sheets and managements are not in a question mark here. Very strong balance sheets, free cash flows, no debt, wonderful, deep management expertise. The only issue is there is absence of AI.
So I think as investors, first of all, last few years, everybody has a great bull run which is going on. We used to keep, as wealth managers, keep hearing from people that we are making 30-40% returns. Can you do better than that? So I think it's a rude shock for a lot of people out there that making money is simple but not easy. And what we require is patience, temperament, discipline, and the knack to keep putting on the hours to study on this. Retail investors are better on because of sectors going through such problems. You have to keep switching when the sector goes through a turmoil, and a lot of times investors not able to do that. So we would advise them to go and invest in mutual funds and other asset classes. But coming to direct equity investors who are thinking of this opportunity, see the frontline IT stocks. If you see, a lot of fund managers also on X and Twitter had raised this question that money could have been well spent investing in these AI technologies versus doing dividends and buybacks,
Yes.
and investing in growth. So I think that question has been raised. Erstwhile Infosys CEO Vishal Sikka had proposed initially that we should put a lot of money in OpenAI when the opportunity was there. I think those are things in hindsight, but what is clear is clearly a lot of these companies have been found lacking in terms of the adaptability and embracing the new technology. And this is not just IT, it is with everywhere. Incumbents typically are always trying to extrapolate the current trend versus invest heavily in the new things. So what we believe is we have to look for more product plays in IT which are using AI to service customer needs rather than pure the incumbents which are just supplying manpower to do coding, testing, writing codes, which is getting disrupted. So one needs to, I think, get out of these plays rather, because see, valuations can keep compressing. It can fall to single digits also. If the terminal value comes in question and all these clients of them are asking that pass on the efficiency gains to us, why should we pay for per manpower when we can get the same work done for 15 engineers from one AI agent? So the thing has become, IT companies will survive, but it will not be the same margins, it will not be the same headcount. Increasing headcount will not lead to revenue. That model is broken.
Yes, I agree with your assessment that terminal value is being questioned, and of course, like any good consumer, he will want any benefit that Infosys TCS are making to be passed on to him as a buyer. Fair point. Let's now expand this discussion. This is turning out to be a stock pickers market, mainly on account of the kind of pain that we are seeing in mid cap and small caps. Ashish, what lens are you using to pick up one, quality stocks for the long term, which have corrected sharply from their all-time highs, mainly on account of this froth getting out of the market? What are your top 2 or 3 picks? Let it be an educational discussion.
Yeah, so just a standard SEBI disclaimer, as Shalini mentioned, that it's an education advice, not an investment advice, whatever stocks we're discussing. So how we look at it is in terms of where is the growth coming. We are primarily growth investors, and are we getting a reasonable multiple for the growth? So using the PEG ratio, PE divided by the EPS growth in the coming years, we try to see how much are we paying for that growth. So for example, in private banks over the last 5 years, median valuations had compressed and the banks continue to do well. And mid-cap private banks especially, you see a lot of FDI interest this year with investments coming in RBL Bank, Yes Bank, and Shriram Finance in NBFC sector. So even global interest was there. So that is one sector space where we find a lot of mid-cap banks interesting. DCB Bank is one bank we have spoken over the years several times in terms of the pedigree of the management and how they continue to execute well. Other good NBFCs are, for example, Aavas Finance, SBFC Finance. Again, mostly, so we see mortgage-backed or property-backed kind of banks and NBFCs where their collateral is great, is not getting disrupted by fintech because your hypothecation and the entire cycle is offline. There is a lot of assessment of the property documents plus the cash flows of the business, and there is a secular growth path for these companies where mortgage to GDP ratio is not even 20% in the country and can go multifold higher. So that is one space. Then domestic tech plays, for example, the IT companies servicing trucking industry, for example, Blackbuck. Today, the trucking industry is worth lakhs of crore rupees. Now you're getting a company with, say $1 billion market cap roughly, and which is continuously getting market share, coming out with various services to service the same sector in industry, from starting from tolling to telematics, now to insurance, now to financing the same people. That is improving. Similarly, for example, in the online booking space, where you have giants globally like Expedia, Booking.com, you have an Indian player called iXigo, wherein they are solving customer problems. For the first few years, they didn't even charge any money till the time they figured out how to monetize, how to solve problems. For example, railway bookings, they become the number one player in the country in terms of rail bookings because they solved pain points. So I think the future belongs to companies which are solving these pain points and scaling up. Our erstwhile discussion about stocks like Eternal, Policy Bazaar continue to do well. They continue to execute well. For example, Policy Bazaar has leader in online space and now gradually scaling up both in the offline space as well. So these are domestic stories. These are unaffected by global tariffs and other things. They are competitive. They are supplying to the domestic market and they continue to grow well. So we look for these opportunities. The framework which we use is called the Ranking of Business Models framework. We discussed on online also. It's there on our YouTube channel and our blog perfectresearch.blogspot.com, where we say that you look for management, you look for longevity, you look for industry structure, business economics as some of the essentials in terms of looking at the stock scalability, and then you allocate based on the valuations and annuity growth and other desirables. So that model gives you a framework to look at. Tailwinds is one of the biggest factor one looks at which sector is experiencing tailwinds to look at quality stocks.
Okay, so Exigo I got, ladies and gentlemen, this stock has corrected from a high of 340 all the way down to 200, and at the same time its market share is rising. Please keep an eye out on its earnings as well, because from there you will get a idea as to how the earnings momentum is moving up. I think the first company that you mentioned was Blackbuck. Am I right?
Correct.
Okay. So again, ladies and gentlemen, two stocks. Look at how Exigo has corrected about a third from its all-time high, and this is in very simply the margin of safety on stock price. So generally we have seen quality managements with good balance sheets reverse back to their mean and then make good highs and better highs. So please keep an eye out again, and as Ashish has said and I am repeating, this is an educational discussion for how to pick stocks. If you do wish to buy Exigo, please consult your financial and technical advisor. I'll also request the PCR to please show the chart of Blackbuck. This is a company that recently launched an IPO about 2 years ago, and what we see at this point of time is a price which is substantially below its all-time highs, which was somewhere in the vicinity of 746. You've seen 525 and now it's at 635. So these are two stocks. Now, Ashish, because you get so much deeply into earnings, in the third quarter earnings, have you heard of companies who are using artificial intelligence? They are not IT, but they are using artificial intelligence very sensibly to increase their businesses and to maybe get hold of customers in a far more better geographical spread and at lower cost. Anything that has hit your eye or into your ear in third quarter?
So I think one of the biggest examples could be Bajaj Finance. We also operate in the NBFC space ourselves, and Bajaj Finance is using AI to almost operate all customer interactions. There is a substantial saving that they continue to double and triple the business, while at the same time reducing manpower. Now that's unheard of. In an NBFC sector or in working, it's very manpower intensive. Now wherein you're able to monitor quality, they are moving from, say, using 15% AI for handling audio calls to almost 80 to 90%. And each quarter, they keep coming out with new AI tools, how to solve the pain points of the customer, how to make it more efficient. So I think one of the classical best examples would be to look at a Bajaj Finance, how laboriously manpower intensive operation, because you're dealing with customers as small as 20,000, 30,000 rupees loans. and you have such a plethora of queries which could come, not just from the problems with the equipment to related to repayment to structuring of the payment terms, how to make payments, the challenges of collection, everything they are trying to drive through AI, and this will lead to them becoming more and more dominant versus other players because they will have challenges trying to match up the cost of operations which Bajaj Finance is now coming to. So I think that's a great example of how AI is being used to revolutionize the industry.
Okay, this hits closer home because Ashish also operates in NBFC, so he knows about the integrities of, arranging that loan and then servicing it, and the cost associated with it. So Bajaj Finance, BlackBuck, and Exigo, these are understood. Ashish, what else? Where do you find value at this point of time in large caps?
See, large caps in general, if you see the correction also has been more steeper in the small and mid caps where froth was also higher. Large caps, I would say still companies like Policy Bazaar are doing a great job in terms of getting market share. See, don't look at market caps when you look at these companies. Look at, for example, what is the market share which they have.
Yes.
So that opportunity is so great that they can continue to double and triple every few years in terms of every quarter they are getting market share and gaining. So the incumbents are getting destroyed. Now similarly, other companies are also interesting where we are having a look. Meesho has come out with an IPO. They are doing a great job. We are trying to understand valuations more and see whether we can take a call on there. But these are companies where even they are trading at 50,000 crore market cap, they can go to a 5 lakh crore market cap.
Which one are you talking about? Meesho.
Meesho, we are evaluating that business also because again they have cracked the tier 3, tier 4 market in a manner which nobody else has been able to do that, and the opportunity size in terms of a local company becoming an Amazon or like this growing, India also will have these kind of opportunities going ahead. So again, this is something where we are evaluating a good entry point in this business. What happens is sometimes markets punish them for short-term quarterly losses. And typically one needs to take a stand wherein the inflection.
I think we have a technical disconnect. We will try and get back to Ashish shortly. But look at the long-term chart of Meesho. This is a company that came out with an IPO price of 111 rupees and it got listed at somewhere like 162 rupees. This is December 2025. Okay. Ashish, we were just discussing Meesho on air. IPO was at 111 rupees. The stock got listed at 162, went all the way up to 250 and is now available at 150.
Correct.
So, ladies and gentlemen, always look at what is left on the table.
Correct.
So now you have an opportunity to get into the stock below its listing price. Remember, listing was 162. Can we always find the bottom? Not at all. Can we sell at the top? No. What we can do is very sensibly look at quality stocks where market share is rising and they are in an industry where growth is there. Today, all of us who
one more thing we can look at is when the bloodbath finishes. For example, Urban Company is another company which we like. But the Instamate segment they have entered, they are having a bloodbath with a competitor Snapit. So once that bloodbath subsides, once winners emerge, you can get good valuations to enter at that time. For example, food delivery space. Once Amazon, Uber, all of them backed out, there you knew that the winners are now out there. And you can back on them and they'll keep increasing profitability. So sometimes you have to keep a track on that also, that once the bloodbath is over, the profitability chart can come quite quickly and you can rise ahead also.
Okay. So Urban Company, ladies and gentlemen, got listed on 17th September 2025 at a price of about 162. It is now available at 121. So please keep an eye out on these 4 companies from the new age space, which is Urban Company, Meesho, Exigo and BlackBuck. BlackBuck, of course, is traditional technology, but these 3 make sense: Exigo, Meesho and Urban Company. Please go through their quarterly earnings on a sequential basis each 3 months. see whether they are getting market share or not, winning market share above from the previous quarter, and then probably take a call. So, Ashish, we've discussed 5 stocks so far: Urban, Meesho, Exigo, Blackbuck, and Bajaj Finance. What else?
I think in general, I would just say that market is becoming more stock specific. The general throwing darts will not be useful. So for a lot of investors who may not have the time, I would suggest it. Please take your financial consultant and advisor to go ahead. In turnaround bets, coming to your question, chemicals is one space which is, I think, bottoming out and could provide a counterplay in the coming times. Otherwise, I would say consumption in general, wherein it is backed by tech, not by through the FMCG distribution channel, will continue to give good results. So that is one space which we can walk out. Other interesting place could be, for example, this company called Unicommerce, which is a play on the internet platforms of the companies. It supplies inventory and other warehouse management logistics solutions. Plus, it is like Shopify backend for the internet companies out there. And promoters recently put money. It is available much below valuations.
You're talking about, yeah, Ashish, just a moment. Let me just get it on screen. It's Unicommerce e-solutions. PCR, kindly fire that chart. We've seen a high of 240, now available at 101. The company got listed in August of 2024 at a price of about 256, actually 188, now available at 101. So Unicommerce e-solutions is also something that you need to look at, folks, and this is a good study that we are doing. Remember, we are practicing buying pain because Ashish bhai, it is critical for people to understand that the only thing that we control in our portfolio is our buying price. There is nothing else.
That's a great line.
And nothing else. Earnings are dependent on what the company does and what the market allows it to do. Competition is what we cannot control. The only thing that you can control for your long-term health of finance is your entry cost. And that, ladies and gentlemen, should be much below the all-time high. In a sector and a stock where market share is rising and there is a huge blue water opportunity in the sector. So,
and markets give you those opportunities. Markets give
yes,
you those opportunities
exactly.
if you're patient.
You know, yes, this is what I'm trying to say. If you think what Ashish and I are discussing is, some textbook theory where such wonderful stocks exist, that's not true. They are in the market. You just need to have a lens on what to look at. So we are primarily focusing on the internet space or the tech space where stocks have fallen dramatically from their all-time highs and are now showing good business.
Promoter recently put in his own funds at around 139 rupees, 140 rupees. So again, showing confidence. They're Snapdeal's ex-founders. So good pedigree they come with. And as you keep getting more internet penetration, as you keep platforms keep performing, as a Shopify for India, they will keep doing well in the long run.
Exactly. So with this wonderful discussion, Ashish, you and I can talk on for hours and hours about quality stocks to pick. But again, it was such a pleasure listening to you and to looking at a very different subset where the market is operating. So be a value picker and buy quality at a painful time, and you will reap the rewards, if not soon, then on the medium term. And again, please also consult your financial and technical advisor on the 5-6 stocks that we've discussed. Ashish, we will be meeting it.
So, yes. Advice. Thank you.
Yes. Okay. And I just wanted to understand how many of these stocks are a part of the NBFC portfolio?
All of them.
All of them.
All of them.
Okay. Perfect. So with that very clear disclaimer for you, and these are all long-term stocks. We'll close this, and Ashish, we are going to meet shortly.
Thank you.
That, ladies and gentlemen, was a wonderful discussion on how to buy quality at a painful point and create long-term wealth for your portfolio. Again, I say, please consult a financial as well as a technical advisor if you get into any of these stocks at current values. Thank you for watching. There is more and more happening on Business Today Television. Please stay glued.
பங்குன்றத பத்தி
அது தமிழ்நாட்டுக்கு ஒத்து வராது அப்படிங்கிறது எங்களுக்கும் தெரியும், அவங்களுக்கும் தெரியும். அது இடையில சில பேர் கிளப்பி விடுற பிரச்சனை, கூட்டணியில் ஏதாவது முறிவு ஏற்படுத்துமா அப்படிங்கிறத ஏற்படுத்துகிற ஒரு திட்டமிட்ட சதி செய்ய